So unless you have an enormously large personal or household income, it's virtually impossible nowadays, especially with rates, to scale to 5 investment properties. The debt servicing calculations with Australian deposit-taking institutions just don't facilitate that level of lending. So we end up with a process known as lender sequencing. And all property investors with 3 or more properties would have experienced or had a situation where they have had to seriously consider lender sequencing and maybe even have had to do it. So let me talk you through what lender sequencing is and how it's going to work for you to help you keep and move forward with your next couple of investment properties. And here's the core problem. There is a difference in all bank servicing calculations, and there is a difference between Australian deposit-taking institutions, otherwise known as Tier 1 banks, all your big ones, and non-deposit-taking institutions, which are regarded as your second-tier lenders or even finance companies. Now, why does the discrepancy exist? Well, the discrepancy exists because the governing bodies of banking insist that if you're going to be a deposit-taking institution and take money off mums and dads and then lend it out to property investors, you better have some really strong responsible lending policies in place. Now, obviously, those responsible lending policies are usually, number one, all loans lent out need to have a 3% buffer to calculate for variations in the RBA rate. And the second thing is they must take into consideration that buffer at the highest point of the loan payment schedule. Now, what does that mean? If you have an interest-only loan and then you have 25 years principal and interest on the back of that, the point of the highest payment is when it moves from interest-only to principal and interest and at the buffered rate. Now, this is what causes the most amount of grief when property investors are trying to continue to borrow using Australian deposit-taking institutions. So, how do non-deposit-taking institutions and finance companies do it differently? Well, they don't have to implement the same buffer across all of your previous loans. They only need to be responsible by putting a buffer on the property that you are purchasing or the specific loan that they are looking at refinancing or refinancing and increasing. So what that means is they can adopt the actual payments for your other facilities on your other property and take that actual repayment rather than the buffered repayment. So why is this lesson so valuable? Well, the lesson is so valuable because as you borrow more, the problem compounds because a deposit-taking institution needs to put the buffer on every single one of your loans that leads up to the actual transaction that you're looking at doing. Now, it's this bit of knowledge that leads into a practice called lender sequencing. And lender sequencing has 3 distinct phases. So let me talk you through those phases now. Phase number 1, exactly where every other property investor is. We go to a deposit-taking institution, one of our big banks or smaller banks, and we borrow as much money as we can on our primary place of residence and usually our first investment property or our second investment property. But at some point in time, you're going to be cut off when your debt to income ratio gets around about 5 times and your income just can't service all of that debt at the buffered rate and also at the term that the bank must put it over in order to provide responsible lending for serviceability purposes. Then what happens is once you've exhausted that opportunity, you then move to a lender that is a finance company or a non-deposit taking institution. And what they will be able to do is they will be able to use your actual payments on your bank loans and then have as the payment that must go in their calculator, and then they will have a reduced buffer on the loan that you are trying to obtain for them for the new purchase or for the equity release. How much of a difference does this actually make? Well, let's run through some numbers based on today's interest rates. If you are looking at those same loans, let's say we've got $1.5 million borrowed for investment, it's all on interest only and it's all at 6.59%. Well, in the actual payments on that is about $98,000 per year. So our non-deposit taking institution puts that in their calculator as a commitment of $98,000 per year. Whereas a deposit taking institution needs to work out what the payments would be on the $1.5 million worth of debt with a 3% buffer. So they're going to work it out at 9.59%, but also on principal and interest payments, because that will be what is remaining after the interest only finishes, over the remaining term of the loan, which on a 30-year term, 5 years interest only, 25 years still to run. So the principal and interest payment at 9.59% over 25 years on $1.5 million is $158,000. So a discrepancy in the servicing calculation of $60,000 per year. Now, how far can $60,000 worth of income take you? Well, in a non-deposit taking institution, it usually will give you about 6 times that in return. So we're immediately looking at you having the ability to borrow maybe another $400,000 with a non-deposit taking institution over a deposit taking institution. So that's phase 2 of the process. Then lastly, phase 3 of the process, you target banks or target non-deposit taking institution and funders that are specific investor style funders. So for some people, this might mean transitioning to like a semi-commercial type facility where they might target rooming houses or multi-unit buildings that have this kind of hybrid, it's residential, but it's not really a house type facility. And those lenders tend to push the envelope a little bit more. Or clients might pivot and move into commercial where they will get a higher yield, and usually commercial lenders won't need to put buffers on those other facilities either. So we kind of move through deposit taking institutions, non-deposit taking institution, and then specific funding options for investment property. Then once we've got the idea of lender sequencing into our heads and the importance of being able to extract equity from a specific property without touching any of the other ones, then you can see how important it is to know the difference between a cross-securitized property portfolio and a standalone property portfolio. No point getting to this stage of your property investment career and then working out that you can't refinance or you can't get equity out of one specific property because it's linked to everything else that you have. When you come to debt sequencing and you just want to take one property to a specific lender to get the equity out, to then go and facilitate another purchase, you need to make sure that the properties are all standalone facilities so you can extract the equity from the properties that have performed well and also disregard the loan to value ratios and the lendings for the properties that have not performed as well. Now let's see how this pans out in real life. We've got a little bit of a case study that we did last month here in the office, and we had a client that had his properties pretty well structured, all standalone, Australian deposit taking institution, was really keen on having a good low rate on all of his properties, and that's where he had kind of lent towards. But of course, this kind of mentality leads to him being stuck. Now, we had a look at it, and because all the properties were standalone facilities, we were able to cherry pick one property that he had that actually sat in the middle of his portfolio as far as timeline sequencing went, and we were able to show him that if we refinance that property, we would be able to get enough equity out of it to facilitate one more purchase. Now, there was a bit of a barrier there. You need to understand that these lenders are not going to be as rate competitive as your deposit taking institutions. So the rate that we were looking at was approximately about 1% more than he had been paying on the rest of his portfolio. But this made the difference between him being able to purchase another one and not being able to purchase another one. And when we have a look at the dollars and cents return on one more property being purchased and held over a 10-year period, then you can see that obviously, an extra % on interest rate, maybe that means on a $700,000 purchase, costs an extra $7,000 a year in interest. is that property going to go up by more than the $7,000 a year and make a profit? Well, of course it will if it's a well-chosen property. So there is an opportunity cost there that you need to decide whether it is appropriate for you, but there is a process with that as well. Once we've made the purchase, let it sit there for a little bit, and then we can reassess in 12 or 18 months to 2 years, and hopefully with a reduced buffer loan from a deposit-taking institution, we can do a dollar for dollar refinance and get it back onto a cheaper rate. So if you find this idea of debt sequencing interesting to you and you want to sit down and have a chat with someone and see how it might work in your particular set of circumstances, what you might be able to do and what the costs of doing that might be, then by all means reach out. Happy to have a 15-minute chat, run through your math and numbers, let you know what your options are, and see if we can get you out there making another purchase. As always, if you found this information useful to you, like, subscribe, and share it with a friend.